May I, at this point of time, request Mr. Kt Chandy, partner Ernst & Young, to please step forward and educate us on REITs. Ladies and gentlemen, put your hands together for Mr. Kt Chandy.
So I'll keep this fairly brief, and I'll go through this presentation fairly quickly. I think it may be better to leave some time for discussions and any questions that you may have. So the genesis of this discussion really is how do we get more funding into the Indian real estate sector? And more funding really gets the engine moving, and there is more traction for everybody involved in the sector. So what is really, and I'll go through this fairly quickly and I'll leave myself open for questions. So what is a REIT? A REIT, as the name suggests, stands for a Real Estate Investment Trust. It is a vehicle to pool real estate assets, which assets that can then be listed on a stock market and on the Indian stock market, which can be contributed or can be subscribed to by a bunch of investors. What is the REIT situation in India? In India, REITs began as a conversation way back in 2005-06. The first regulation came out in 2007. It went silent for a while. 2013 things picked up, and in 2014 SEBI notified regulations on the issue of real estate investment trust. So this is basically a trust that houses real estate assets that can be listed on the market and can be subscribed to by most of us. Why is REIT so important and what is happening globally? REIT is important because it enables developers to deleverage their balance sheet. It enables a different pool of capital to come into the market and reduce dependence on banks. World over, there is a pool of capital that is available for investment in fixed income yielding assets. And as these REIT regulations get active in India or get activated in India, you will see many more, much more foreign institutional money flowing into the country. So this slide is telling in the last couple of years, more than 72% of the money raised globally by real estate companies by tapping the listed markets have come from the REIT sector. So 72% of money raised by real estate companies globally has been from the REIT offering. 2014 was also good, and we have data till the first half of 2014, reviewed data. More than almost $7 billion of money raised in the first half of 2014 globally. The main markets for this, as you can imagine, are the US and Singapore. Singapore is most commonly known, and there are some Indian assets listed in Singapore, the Ascendas Trust, the India Bulls, and most recently Religare. Why is the REIT asset more liked by an investor than an IPO asset? The REIT, by its very definition, requires a developer to place income earning assets into a trust, which trust is then listed. There are then prescriptions on the quantum of money that can be retained in the trust and what needs to be dividended out. So under the Indian regulations, 90% of the earnings of the real estate trust coming from lease rentals has to be paid out as dividend, and that too on a half-yearly basis. So REIT therefore becomes a fixed income asset for people who invest in this asset, and it is also a natural hedge against inflation because the unit price keeps going up. It's a listed security. Unit price keeps going up as the underlying asset value increases. I think we should go to the next page here. So why is Bangalore an important market? You would have seen and you would have heard in the papers of multiple developers with large real estate commercial properties looking at the REIT market. But why is Bangalore so important for the REIT market? It is because there is a huge offtake of commercial property that is income generating and therefore perfect for the REIT market. And there are a bunch of investors and developers who have the required asset size to make an appropriate REIT offering. So there is a lot of data we have on why the Bangalore micro market is the best in the country for a REIT offering, and we know that there are a lot of developers actively looking at how to get their assets into a REIT structure, and which will help them deleverage their balance sheets. Can we go to the next slide? So this is really what interests the various stakeholders in a REIT. On the developer side, it releases block capital, so it enables the realtor or the developer to list his assets and release cash into his other projects. It also gives an uplift to the value of the group as a whole. So a certain asset pulling a certain value, and the rest of the group is automatically valued at a particular price. It also enables the developer to control, in a REIT you obviously have to give up some of your control, but it enables the developer to still retain control and branding over the asset that he has. For the investor, steady cash flow from professionally managed assets. SEBI controls it to a large extent. Therefore, all the disclosures and the norms, there's extreme comfort among investors. It also opens up, an investment avenue for retail investors who otherwise, who don't want the stock market in some ways for scripts, but real estate REITs has an underlying asset base and a steady income flow, which really enamors a lot of these investors. It also provides a lot of them access to the real estate market with the comfort that they can exit whenever they want. So it's an in and out, and sometimes investors are concerned about the time taken to enter and exit. So I won't go through this too much. This is the structure for a REIT. You really need to have a vehicle, a trust, into which trust assets need to be thrown in either directly or in wholly owned subsidiaries or 50% owned subsidiaries of the trust. There needs to be an investment manager, a person who's responsible under SEBI regulations for managing the real estate assets. It can be the developer. You need to have certain qualifications. You also need to have the sponsor and the trustee to the REIT. So there are a list of players, again very clearly specified by SEBI regulations and in place to enable such a structure to come into play. There are prescribed income streams. While there's no upper limit, there are income streams on property management, on property leasing, and various other activities that SEBI has blessed here. So this is a classical structure. Again, the challenges, if I can get to the next page. So there are certain conditions, again, which gives comfort to investors and developers. They're working within a particular parameter on what is the size of the trust. So you need to have at least 500 crores worth of assets in that trust. This 500 crores can be contributed by more than one developer, so it can be 3 developers coming together. The developers need to offer 25% to the market. So they can retain a large control. They have the flexibility also to dilute all the way down to 15%. The asset condition is that 80% of the REIT assets should be in income generating assets. Income generating assets means assets that are already rented. So there is a limitation on what can come into this trust. Now here again, it can be all types, right? It need not necessarily be a real estate developer who puts his assets into a trust. It can also be a corporate who owns a large facility. For example, let's take the example of Infosys, who owns large assets, real estate assets, which they themselves occupy. So it's conceivable that corporates such as these put their assets into the real estate, they carve it out and put it into a trust, The services business of Infosys, for example, continues to use the assets, but those assets are separately monetized by corporates. So this is useful not only to the real estate developer, but also to a large set of corporates who may own assets and who may want to monetize those assets. The income distribution condition is that 90%, and this is the fundamental thing, 90% of the rental income earned by the trust is to be distributed to the unit holders at least biannually. So again, by this structure, the government and SEBI wants to give comfort to retail investors for a fixed income return asset. Sponsor qualification, if there's only one person who contributes asset, that the developer should be worth 100 crores. If there are 2 or 3 that get together, the minimum net worth should be 20 crores. And there are prescriptions on minimum time in the real estate sector. So 5 years is easily achieved by most people who have a couple of projects. Manager qualification, also people who can manage the real estate asset, who are responsible for leasing and the upkeep of those assets, is also not overly troublesome. It's 5 years, and most people would have that. There needs to be a minimum net worth of 10 crores, and it needs to employ 2 or more people with 5 years of experience. So why is this important? Why we thought we'll present this at this forum is that today, as we all know, there is a paucity of funds getting into the sector. So here is a new avenue to raise capital. And as capital gets into the sector, developers and builders of assets can utilize that cash to free up stuck projects, generally get velocity back into the market. So lots of people are looking at it. Now, what is the constraint? As you can imagine, the constraint is largely tax related on how will these assets move from where they reside today and into the trust. There are a set of capital gains tax issues, minimum alternate tax issues. The government has been cleaning this up year on year. So the last year there were a lot of exemptions provided. So the trust is largely see-through for assets that are reside in the trust. There are structures that are now available where most of the money earned by the trust can be repatriated straight to the investors. So lots of tax issues are getting ironed out. But as they get ironed out, I think it's for the industry to start thinking about which are these assets that are amenable to a REIT-like structure. How can these assets be pooled together if one developer does not have it by themselves? How can it be pooled together? How can it be moved into the trust? What is the tax efficient structure that will facilitate attractive returns for investors and thereby make the offering more potent? Just get the REIT, just get the structure cleaned up and ready. What are the other terms? Are there any loans outstanding? If loans outstanding, what are the arrangements to pay that down with REIT capital that is raised? So lots of things that the industry could probably think about. Now the other thing, as we talk to developers, the key other point that comes up is this regulation is already a year old. Who has done it so far? So the answer is, today nobody has done a REIT listing in India, but it's still too early. It's only 2014, and if you have to understand this, you have to anecdotally look at Singapore. So Singapore issued REIT regulations in 1999, and it took till 2002 for the first offering to come about, and that was an offering of a mall property. So it's CapitaLand Malls, who accumulated a bunch of malls which are rented out and which have steady stream income, and offered it to investors. Till 2004, so that's 5 years later, there were only 3 listed REITs. And today REIT is the most common way in which money is raised for income generating real estate assets. So therefore, we think, from the analysis we've done and from the interest that the industry is showing, that this is going to be the next real vertical in which cash can come into the sector and generally propel additional growth and activity in this sector. So with that, I'll pause and I'll ask if there are any questions, and we can be reached. Farooq and the rest of the NAR group have our details. If anybody wants any information, we are more than happy to share our knowledge to the gathering and to the members as you deem fit. No, it has to be in the REIT structure, the money that is raised, or when you raise the money, it has to be in completed projects and income generating projects.
Yeah, that is a second hand, like a resale property. The investment can be made on a retail, not a brand new property. It doesn't matter whether it's a brand new or a resale property. Resale properties. Yeah.
What he means is that supposing the developer has built it already and it's bought by somebody else, and can that property be again taken for a REIT?
No, it can. So we have to look at the structure on where it is pledged, and it's the discussion with the person who has a right on the asset on how can monies be used to free up the asset. So you can have a pledged asset sitting there, and your prospectus saying that the money raised will be used to clean up this asset, and then have free cash flows go out to the investors.
What about entry load? Does entry load apply like a mutual fund? Do you have an entry load in these REITs?
No, there's no entry load. It's a public offering. It's an IPO of an asset. So, that the market has to find the level, but we would think that
what is the exit period on that?
So it is a listed security. So it's listed on the market. Today, if it's listed for 100 rupees, for example, and I'm talking only of exit, the price of that share or that unit will depend on how the underlying asset appreciates in value. So it can be whatever, it can be 150 if that asset is going up, and that is the price you get on exit. So the unit holder has the ability to exit at whatever price. So this is a natural hedge against inflation. So what the government is thinking about is that, most of us would put it, if you're not knowing the stock market or individual projects where you need large sums of money, we put it in bank deposits. Can you put it in a REIT where you have access to real estate that is appreciating, and at the same time earn bank interest, bank deposit linked returns? So to answer your first question, what is the expected return? I would think, a shade under the bank deposits, but to kick it off and to get investor comfort, you may need to lift that a little bit. But you can't promise a return because you can only give what your property is earning. So therefore it will all be very clear. This is the rent that is the assets are earning. These are the taxes along the way, if any, and this is how much can go out.
Thank you so much.
If the REIT owns an asset, it has the ability to sell the asset and redeploy that money into other assets or return the money by upwards by distribution.
Thank you, Mr. Chandy. Really appreciate it. Ladies and gentlemen, a round of applause for Mr. Chandy, please. Thank you so much, sir. Thank you for coming and sparing your time.